Good evening, ladies and gentlemen, and welcome to tonight's webinar. My name is Conrad Bobilak, and I'll be your host. And tonight's webinar is called The Perfect Storm is Brewing in the Melbourne Property Market in 2020. Find out where to invest and which areas to avoid, like the plague, like a Kenny G concert. Now, before we go on, I just want to make sure you guys can see my screen and you can hear me as well. So if you can type in, yes, we can hear you, yes, we can see you. Thank you. Thank you, Betty. So that's a yes for sound and a yes for the screen. Is that correct? Perfect. Thank you very much for that. So before we go on, just a bit of a personal disclaimer. My results are untypical. I'm not going to insult your intelligence by promising or implying you build a multi-million-dollar property portfolio like I have. But I'll show you exactly what's worked for me and give you some pointers on how you can implement similar strategies. And in the event that you find them congruent with your risk profile, investment time horizon, let me know and I'll take all the credit. I'm just kidding. Like I say to people, there is definitely no guarantees in life. The only guarantee is if you do nothing, you're going to end up dead broke with one house paid off. Asset rich, cash flow poor. For those who haven't heard me speak before, just a bit of background. My name is Conrad Bobilak. I've wasted 4 years of my life at Monash University playing pool at the tavern and drinking beer and doing assignments with international students who couldn't speak English. And I ended up doing the entire assignment and all the presentations. After wasting 4 years of my life there, nearly did an MBA, more bad advice. But I decided that money could be a good thing. I like money. So I ventured out into the world and got a job in financial planning for Australian Unity Funds Management in 114 Albert Road. And I used to work with unlisted property trusts and life insurance and all sorts of investments. I left there because my passion was real estate investing, and I started working in lending. I worked for NAB in residential lending, and eventually at the end of my career in lending, I worked for a company called Medfin, which is a publicly listed company in the stock exchange, and I was looking after dentists and doctors in Melbourne, setting up medical clinics, dental clinics, doing commercial finance, asset finance, and residential lending. Pardon me. I also had a mortgage broking company as well that I started, and I had 13 mortgage brokers working for me. And then I left that world after getting bored with mortgages and set up my real estate company, which is Investors Prime Real Estate, where I source the best performing properties in Melbourne in the top 50 best growth suburbs. I'm also the author of Australian Property Finance Made Simple, which you can get in any good bookshop, online at Amazon, or on my website, bookonfinance.com.au. And I'm very pleased to say as well that I've just finished writing, after 3 years, Australian Real Estate Investing Made Simple, which is currently going through editing, and the graphic designers are doing the layout of the book, and they're nearly halfway through. So that's definitely going to be out probably in a few months as well. So you'll definitely be hearing from me about that book coming out. And yeah, it's been a whole journey, a long journey to get that book finally completed. Look, I'm pretty lazy by nature. I'm not one of those people where I can lock myself up in the wood cabin somewhere in a jumper on a typewriter and just write 10 hours a day. This book, when I didn't feel like writing, I didn't write. Sometimes it'd be a month go by before I even touch it, and sometimes in the winter when it's raining and there's nothing to do, I would write a whole chapter in one day. So it was a kind of book where I had to be really inspired to actually write the book, and it came out really well at the end. Pretty much everything I've learned in the last 20 years is in that book. So I'm very, very proud of that. Tonight's webinar is about which are the best and worst suburbs to target in Melbourne in 2020 and beyond. And here's some of the things that I'm going to be covering in tonight's webinar. The 10 best suburbs to buy right now in February 2020 that are destined to grow by 18 to 20% over the next 2 to 3 years. And I'll show you what I think will happen in some of these areas, and I'll show you what happened in 2019 in some of the areas that I've been highly recommending. Why Melbourne's house and land estates consistently underperform or just keep up with inflation, which is 3.75 over long term, short term 3.25, and why you need to avoid Melbourne's house and land estates like a Kenny G concert, unless you want to get 3% per year, obviously. Now, remember, if you're getting 3 or 4% per year, inflation is around 3.25. So you're actually not getting 3% growth. You're getting a little bit about, 0.25 or 0.5% growth. I'm also going to go and cover my top 2 best recommendations for budget underdog suburbs that are currently going through gentrification. And these are suburbs that will outperform everyone's expectations in this property cycle. It's one of those stories where 6 years from now, people will be going, I can't believe that area did that. Who would have known? Well, you will know if you're on tonight's webinar. It's an opportunity that has a very short time frame because land is going up a lot in the area already, and developers are not silly. They know what's happening, so they are increasing prices as we speak. I'm also going to go through Melbourne's low-density boutique apartments in blue-chip suburbs. Why, even though they've worked well last year, they are a minefield, and I think there's going to be some issues there. But once again, I'll tell you what's happening in those areas as well. I'm going to give you my number 1 best capital growth suburb in Melbourne for 2020 and 2021, and I'll show you why I think that suburb will outperform every other suburb in Melbourne, and 8 areas that you need to avoid like the plague as well, which you don't want to invest in the next 3 to 5 years. You're going to get very low growth, which means you won't be able to build your property portfolio. The problem that I see with a lot of investors coming into the market now is they keep relying on technical analysis. Now, if you keep doing technical analysis, guys, you're not going to get very far in real estate investing. You've got to do fundamental analysis. You've got to be street level, understanding the suburb, the demographics of the area, the people, what they want, the schools, walk score, income per individual, income per household. You got to see what's happening at the street level of a suburb. You cannot just sit back somewhere on the computer and read charts thinking you're going to pick a winner. It doesn't work that way. I have never met an investor in 25 years that has successfully made money out of technical analysis. Warren Buffett, the #1 investor in the stock market, does fundamental analysis. If you don't know the difference between the two, look them up. I have done a webinar on this topic before, and the methodology that I use is fundamental analysis, street level, backed up by technical analysis. So I've got both angles covered. And when both are pointing into the same direction, I know I'm onto something. And that's the winning formula that I've been using. Melbourne property market update as of January 2020. So I want to give you a bit of a macro level update on the property market. And then I'm going to go into micro level, specific property, specific suburbs, and give you a really good understanding of what's happening, in terms of different areas and where to invest and what to look out for. And then I'll take questions at the very end. So please write down your questions because I'm definitely going to cover them. So if you have any questions at the end, I'll have, I've got about 15, 20 minutes where I'll be answering questions. So you're more than welcome to ask any question about any topic that was covered throughout this webinar. So remember, the first thing to know is there is no such thing as the Melbourne property market. Just like the Sydney property market, there is no common market. Melbourne is Toorak and St Albans. Melbourne is extremely fragmented and there's no spillover effect between different segments. The markets work independently of each other, and there is no correlation between these markets. They actually have different statistics. Agents don't even report them in a combined fashion anymore because there's no point. So, people ask me what's happening in Melbourne. It's a redundant question. There is no Melbourne property market. There are distinctive markets within Melbourne doing independent things because they have different people living in there on different incomes, working in completely different industries, and they have no reliance on each other. For example, in the West, you have a lot of people that work in car manufacturing, assembly lines, like Broadmeadows, for example. And then you've got the inner East, where the majority of people work in the banking, financial services sector, in the white collar sector. There's no correlation between the two. One can shut down, the other one can boom. And that's exactly what's happened in the last 3 years. As you know, manufacturing has come to an end in Melbourne with Toyota, Mitsubishi, Ford, everyone exiting the industry and outsourcing overseas, and hence why there's a lot of unemployment in the Northwest and the West, where the inner East and the Southeast unaffected completely. People couldn't care less what's happening in that sector as well. If you look at January 31st, 2020, for the month, Melbourne has grown by 1.2%. For the quarter, 4.9%, which is an average, and for the last 12 months, 8.2%. If you add rental yield into the equation, it's returning 11.7%. And the median price for the detached house in Melbourne is $681,925. If you look at Sydney, for example, 1.1 for the month, 5.6 for the quarter, an annual return of 7.9. Return for the year, 11.5. Median price, 862,814. Brisbane hasn't grown at all. It's flatlining. I don't think Brisbane will boom at all. It hasn't got any money, and there's no job opportunities there, and the people that are moving to Brisbane is a fraction of what's happening in Melbourne and Sydney. So the industry is split into two groups. One group thinks the Brisbane's going to boom by 15–20%, and the other group, like myself and other experts, are saying it's not going to happen. I don't believe it's going to happen at all. I think people will be shocked to how low the growth will be in Brisbane. Brisbane has a perfect matching principle between stock on the market and buyers. Even though Brisbane will do okay, and some areas will definitely do well, overall, the market will not boom like Melbourne and Sydney. You haven't got that critical shortage of stock combined with very high income per individuals who are fighting over the same stock. So pretty much in Brisbane, whatever stock's on the market just sells, people buy it, people are happy. And wages are much lower there in terms of the volume of people who are all high incomes is much lower than Melbourne and Sydney. And that's why the median price is only 499,000. And for the year, it's done 1.1%. So you can get okay rental yields, but you won't get the same critical capital growth, I think, in my opinion. Could be wrong. I'm only human. Over the last 12 months, Melbourne has returned 8.29%. 7.9 is in Sydney. And if you look at the 5 years, 32.1%. And since the peak of the market, which was November 2017, Melbourne is still behind, 1.2% negative. So we're about to catch up. And I think by the March quarter, we'll catch up to where we were in November 2017, and then we'll surpass that peak, which has always happened with the cyclical nature of the market. Nothing new there. And it's the same with Sydney now. Sydney has done 23.9%. The peak, it's still 5.4% lower than the peak, which was September 2017. And I think by the end of March quarter, it's going to catch up and surpass that. And then it's going to go up by 10%, 8%, same with Melbourne. And we're going to hit new price points with all the major suburbs. So it's a really exciting time to be involved in the property market because we are at the beginning of the new property cycle. If you look at the best top 10 sub-regions for annual change in dwellings in 2020, Melbourne Inner East is number one in Australia. It's already grown by 16.2%. That's because all the money's there. So if you look at where is the money in Melbourne, you're looking at, Toorak, Hawthorn, Kew, Canterbury, all those areas, and that's why it's taken off. It's done 16%, and then you have Melbourne in the south is doing 11.2, which is also very healthy. And if you look at all the mining towns, Perth is getting smashed completely, and Darwin, Moranbah as well, where the mining sector has died off. Exports of commodities has come to an end, and a lot of projects have been shelved. So all the construction workers are gone. And operational workers are still functioning, but there is no end in sight. So there maybe could be a good opportunity in some of these towns, but I'm not a big fan of mining towns at all. If you look at the top 10 and bottom 10 sub-regions for annual change, you can see there once again, look, regional areas do quite well. You just got to pick specifically which area you want to invest in. If you're priced out of Melbourne, I often say, in Melbourne, go to Bendigo and Ballarat. I mean, it's a microcosm of Melbourne and it's a fraction of the price. And just so you know, Bendigo and Ballarat do have 10% return on suburbs consistently. You just got to pick your market. So if you're priced out of Melbourne, and we'll talk about price points later on, the minimum that you need to enter the property market here, because it is very expensive now, don't get me wrong. I'll go regional before I look at anything else. This is the most important chart that I'm going to show you today, which really shows you where we are in the property cycle. And it's basically showing you 3 lines which summarize 3 price points of the property market. The property market can be divided into three types of properties. Lower quartile is the cheapest properties. The middle is the average property, what the average person buys in each major capital city. And then you've got the upper quartile, which is all the mansions and high-end properties. And this varies obviously between Tassie and Melbourne. There'll be different price points. But if you look at Melbourne, for example, the blue line, the lower quartile would be properties from 150,000 up to maybe 450,000. So the cheapest properties in Melbourne. And then the middle market will be kind of 550 to maybe 850, which is like the middle suburbs. And then you know, maybe even more, 950 for the detached houses. And then you've got the upper quartile, which is your high-end properties, probably about 2 million in Melbourne plus. Now that's the most important market by far, because you can see there that the drivers, that market is really taken off. So that market has gone up a lot from January 2019 to January 20. You can see the red line has just shot up completely. And you can see that that's really the biggest sign that we are in the next property cycle. You can see the middle sector as well taking off. And then you can see that the blue line is also being dragged up, I guess, because those properties will perform as well. But this is a very, very distinctive example of the market going up in value. And you can see that that's happening across the sector. So we are truly going from a decline of the market into the next growth part of the market. Now, one of the most important things to understand is that the property market is counter-cyclical in terms of rental yields and capital growth. So the higher the capital growth, the lower the rental yield. And that's really evident in this chart here. So we can see there ever since kind of January, especially the peak being January 2019, we can see that the rental yield has peaked and now it's going down. So the rental yields are usually fixed for 12 months at a time in the different suburbs, and they're roughly, this is depending on the suburb and dynamics of the suburb, how big the suburb is, but roughly the rental yields take 4, 5, 6 years to catch up to the capital growth cycle. So for example, right now in Melbourne, in 2020, the rental yield is 3.2%. In 2019, you can see it was 3.6. So as the rental yield go down, that means that the growth of the properties goes up. Now, don't confuse rental yields with the amount that you get per week in cash. That's always going up. Okay, rental yield is the relation between the rent in money and the growth value of the property. So you divide the rental by the property and the annual rent by the value of the property times 100. The normal rental yield will be around 4.5%, 5%. So just so you understand, this is a very important point. If you have a property in Melbourne right now that's giving you 5% return, my question is, what's wrong with it? Why hasn't it gone up in value? So you can't have both growth and cash flow. It doesn't exist. It's either one or the other. So the worst performing suburbs in capital growth are the ones that have now rental yields of 5%. It means they haven't grown at all. And if they've grown so little that the rental yield is still the old rental yield, and that's why it's higher. So the best performing capital growth properties have the lowest rental yield, 2.8, 2.5 just now, and then they're going to catch up as the property market goes up. This is a very important thing to understand for novice property investors, because you cannot have both at the same time. You can't have high capital growth and you can't have high rental yields at the same time. You can have one or the other. So just make sure you understand that. So what happened in Melbourne in 2019? Well, in 2019, this is what happened with the different segments of our property market. So the inner market, inner city, the median price is 1.3 million for detached houses. Very expensive for land there, because obviously you're talking about areas which can be potentially redeveloped into high density areas. Quarter on quarter, the last quarter 6.2%, for the year 19.4%. Some of the best growth in Melbourne is places like East Melbourne, North Melbourne, South Melbourne. So places that are just outside the city, one suburb over. Inner East is where the money is, 1.435 million, 5.7% growth for the quarter, 9.7% for the year. In the South, which is really, the Bayside, 1.3 million, so 4.8% for the quarter, 10.2% for the year. Northeast, 730, pardon me, 6.6 for the quarter, 7.1. Northwest, 650. See how it's getting cheaper and cheaper now? 6.6 and 4%. Outer East, 805,000, 7.3, 7.5 for the year. Southeast, 665. So that's 4.8 and 3.9% for the year. And then you've got the West, which is 620, which did 5.1 for the quarter, 4.2 for the year. And then Mornington Peninsula, which is 2.6 and 6.1. Now, obviously, the West and the Northwest, the income per household is much lower than the income of people that live in the East, in the South. Hence, they cannot get higher mortgages. You can only borrow whatever you're earning. So therefore, they can't push up property prices any higher than they are being pushed up right now. And it takes a very long time for an area to go through gentrification. So, you know, this is why these areas cannot perform at a higher rate than they are performing currently. And that's pretty the maximum that they can grow at. So just remember, there's no such thing as a Melbourne property market. They're very distinctive markets. If you look at apartments for growth, inner apartment market, the median price was 570, annual growth 7.5. Inner East, 665, 12.7. In the South, 650, 12.3. Look at the Northeast, 19.4. Northwest, 14. So with apartments, some areas will go a lot higher because people are priced out of detached houses, and it's either they live in the area or they can't live there at all. And that's what's happening with apartments in a lot of areas in Melbourne. But you've got to look at long-term growth. You know, we're in a very specific part of the property cycle. It's very dangerous to look at 12-month performance in some sectors because you've got to average things out over 10 years. Towards the beginning and the end of the cycle, you can have very weird stats that are not representative of the entire cycle. And obviously, when you're investing, you don't want to buy something that just grows for a few years and stops. You want to have something that is a consistent performer over a long period of time. Otherwise, you won't be able to refinance all the time and get equity out. If you look at the suburbs, the top 10 best performing suburbs in 2019 for the year, St Kilda East, which if you watched my webinars 12 months ago, I was telling people this is the best area to invest in. 47.5% for 5 years, 23.6% last year. Interesting. Canterbury, 17.3% for the year. Caulfield North, 14.7%. Flemington, big fan of Flemington, 13.1. Armidale, 11.8. Hawthorn, 11.7. Box Hill, 10.7, especially Box Hill North. I love that hospital precinct. So a big fan of Box Hill and Box Hill North. Elwood, if you can afford it, 10.6. I mean, no one can afford Elwood anymore. It's becoming ridiculously priced. I mean, townhouses selling for 2.5 million in Elwood. Bacchus Marsh, 8.5, 537. That's because there's a lot of new estates there. I wouldn't touch it at all. And Dandenong, 8%. Once again, with Dandenong, there's a lot of new estates being built. So there's new houses, and the median price of those new houses is distorting the median price of the suburb because you're competing with all the houses. So you just got to be careful with capital growth. So in St Kilda East, because it's all developed, you got to rip something down to redevelop something brand new. So there is no more land in St Kilda East or Canterbury or Caulfield. But with new estates that creep into the top 10, you've just got to be aware there's still land available, and that land, once it's redeveloped at a high price point, can misrepresent the true capital growth of the suburb. If you look at the top 10 apartment prices increases, and once again, you know, apartments can be misleading because what they're doing in some of these areas, they're just building bigger apartments. Like Toorak, for example, in Brewing, there's a lot of 3-bedroom apartments being built now. And so the median price has shifted, not because of capital growth so much, just because they're charging more for the apartments because they're getting bigger and bigger. They started off building very average apartments in Melbourne 10 years ago, just 2-bedders, 75 to 85 square meters, you know, functional. But now, because baby boomers really want upmarket apartments, like especially in Toorak, places like Hawthorn, Melbourne, you know, they want large 3-bedders with en suites, with 2 living areas. So they're building them, but they're charging for them as well. But anyway, it is what it is. And if you've listened to my webinars in the past, these areas virtually all have 3-to-1 ratio between the price of a 2-bedroom apartment and a detached house. So Bowen, 802,500 for an apartment, 27% return for the year. Yarraville, 595. Big fan of Yarraville always. It's gone through massive gentrification, 22.1% for the year. Caulfield, 700,000, 19%. West Melbourne, guys, West Melbourne, North Melbourne, East Melbourne, just buy whenever you can. Don't worry about property cycles. Just if you can afford to get into that area as a townhouse or a house, not an apartment, just buy it and hold it. Toorak, 1,010,000, 18%. Blackburn, 17%. Doncaster East, 15% growth. Prahran, Glenmaveley, and Clayton, believe it or not, at 565. A lot of apartments being built in Clayton. Monash University keeps growing and growing, and they're renting them out to students. Would I buy apartments in Clayton? Not in a million years. Students are the worst tenants you can have. Never ever target anything to do with the university campuses or any type of educational facilities. These guys are broke guys. They're students. Remember when you were a student, you were broke and you party inside the property. So if you want to have a destroyed property with tenants that have no money, then buy in Clayton, absolutely. As you can see there, we've had a downturn in the property cycle, and these are the last Melbourne property downturns and recoveries since '93. So you can see there the black line is, and these are based on quarters. So if you see the last downturn, the green line was quite deep. We went down by negative 10%, and we've nearly caught up to the 10%. You can see that we're just nearly hitting zero, and we're just about to surpass that. The previous one, 2010, 2013, was not as deep. We went down by 6.5%, and then we caught up over a longer period of time, though. Look how many quarters it took to catch up this time. You know, the previous, this is 2 years, the other one was 3 years. And then 2008, 2009, very short-lived as well. 2008 was a tiny one. 2003, 2096, 94, and 93. The thing about it is, guys, it's all cyclical, it's all predictable. You know, every cycle is quite a little bit different, but it's to a large extent, the indicators are all there if you know how to read them. And just remember, there's more money that's made at the bottom of each cycle than any other time, because the money exchanges hands between, there's a flow of money between the uneducated to the educated. The educated cashed up developers, especially buy properties from banks. Businesses go under, people lose jobs at the bottom of the cycle, the consumer sentiment's negative, people save a lot of money, they defer buying properties. Developers that are cashed up, they go in, they buy development sites at, you know, a fraction of what they're worth, and they clean up, you know, and this is the reality. I've seen more developers become more wealthier at the last property cycle than ever any time before, apart from the GFC, because they're buying directly from banks, sites that are repossessed from mum and dad developers who couldn't get them off the ground. So, you know, it's very interesting. So counter-cyclical investing, know the market and take advantage of each of the bottom of the market. Definitely. That's definitely where the money is. And if you look at what's happened with housing apartments in Melbourne, these are losses, people that have sold, loss-making sales September quarter 2019. So in Melbourne, 15% of people that sold apartments in the September quarter 2019 lost money on the transaction. At the national level was 19.8%. So 19.8%, nearly a fifth of the people that have bought and sold apartments last year lost money after considering holding costs, agents' commissions, capital gain tax. Darwin was the worst, 61% of all apartments sold lost money. Perth, then Brisbane. Look at Brisbane, 36.5%, Adelaide 23%, Canberra 21.1%, all cities 20.5%, and then national level 19.8%, Melbourne 15%, and it was all Dockland, South Bank, you know, South Melbourne. Sydney 12.5%, and Hobart 1.5%. There's not many apartments being built in Hobart as well. In terms of houses, Darwin 39%, Perth 32%, national 10%, which is about right. 10% of people, 1 out of 10 gets it wrong. All cities 9.7, Sydney 7.9, Adelaide 7.6, Brisbane 5.4, Melbourne only 3.4, which is pretty low. Canberra, it's a very forgiving market in Melbourne and Sydney. Even if you get things wrong, you hold it long enough, you will make money. Canberra 3.1, Hobart 2. So where are we currently in the property cycle? We are at recovery mode, according to the National Property Clock from Harrington White Valuers. We are literally at the state of recovery, the start of recovery being there. You can see the Melbourne where my mouse is. And we're about to enter 9 o'clock. From 9 o'clock to 12 o'clock is 2 or 3 years of extreme growth. And this is where at the time, it's hard to get into the market because you're overpaying. So you want to get in before that happens, and then you just hold properties strategically and let everyone else inflate them. And then there's the peak of the market. At the peak of the market, what I do is I lock in all my lines of credit, refinance all my properties, and then wait for the downturn and start buying from about 3 o'clock to 6 o'clock, which is where you get all the deals, all the bargains. If you watch my YouTube video, 5 ways to buy property with no money down, all those strategies were done, 3, 4, 5 years ago, which was 3 o'clock, 4 o'clock on the market, when everyone's depressed, when there's no sales happening. Developers need sales and volume, and that's where you can do vendor finance and gifted deposits. Now you can't do anything. I'm getting emails from clients saying, do you do vendor finance? No one's going to do anything, guys, because everything's selling. So why would anyone be motivated to even do more paperwork if the property will sell tomorrow? Do you know what I mean? Like there's no incentive for a developer to do vendor finance or someone to do gifted deposits, get creative with finance. Everything sells now. It's over. Like it's a seller's market. Until it stops and we go into 2 o'clock, that's when these people start getting, creative again, because they've got to keep moving stock. It's a business. It's like a bakery for them. There's no emotion. So when the market's hot, they've got no incentive to get creative. When the market's cool, that's when they're getting that creative. And that's when your knowledge kicks in. And that's when, if you have the ability to identify fundamentals, you're going to make a lot of money. If you don't, you won't make much money. I mean, it's that simple. So it's all up to you guys. The only person that's going to make you wealthy is you. That's Melbourne there, going into the start of recovery mode. Going up to the boom of the property market. And the reality is, as you know, you've seen this chat over and over from me in various videos, only 71.6% of individuals in Australia have one investment property, and only 0.9% own more than 6, which is about 19,000 people. So it's very interesting. There's very few people in Australia that manage to grow large property portfolios. Why is it that so few people succeed in real estate investing? It's because they have no strategy. They have a buy and hold and pray to God strategy. They buy something within 4 k's of where they live, hoping that it's going to do well. And just because you bought in Melbourne or any major capital city doesn't guarantee success. This is from 2016, because a lot of apartments take 3-4 years to build. You can see that in Melbourne, out of 390 suburbs for houses, 198 have doubled in median price to 2016. 192 haven't doubled. And apartments out of 220 suburbs that haven't doubled, only 48 suburbs have doubled in median price from 270. So apartments are even worse than houses. So just because you're buying in a good city doesn't guarantee success. Ultimately, your knowledge base is going to guarantee success and your level of awareness. So why is it that so few people succeed in real estate investing? Because they lack the following crucial elements. Number one, the wrong psychology. They don't have a plan or a system. They don't have the right experts around them, i.e. accountant, mortgage broker, solicitor, and they don't have any selection property methodology. They just choose what they understand. So if they live in a 5-bedroom house in Mentone, they're probably going to buy a 5-bedroom house in Cheltenham, and because that's the comfort zone. If they live in Brunswick in a 3-bedroom house, probably going to buy Brunswick in a 3-bedroom house. So if the area you live in is good, then you're probably going to make money, But if the area is average, and you're going to buy there because of your comfort zone, you're going to probably be disappointed. So my objective is always with educating people about getting detached from the investment process. You're never going to live in these properties. Someone else will live there, another demographic that's not like you. These people have different needs, different ideas, and you're just buying it purely to hold properties. And that's the reality. So it's only when all these things overlap can you become successful as a property investor. You got to have the right psychology, the right plan, the right experts around you, and the right property selection methodology. And the definition of all of them synchronized is the definition of success, which is exactly what my book is about that I've just finished writing, those critical parts of building wealth. So what factors really determine capital growth? I'm going to go back to some basics before I go and reveal all the hotspots and areas to avoid. I want to go back to the core of the thing and the simplicity of property. And it really comes down to this lifestyle triangle. And it's really not so much the distance, but the time it takes you to travel from home to work to school or lifestyle area if you don't have kids. Because obviously, if you haven't got kids and you're traveling to schools, there's something very wrong with that. So if you're retired, you've got no kids, lifestyle, being shops, shopping, whatever it is. So if the distance between home and work is 10-minute drive to school to pick up your kids, and then 10 minutes from the school to home, you're going to be very happy where you live and where you work. If you're driving for an hour and a half every day from home to work, and then an hour to school, and then back home for an hour, you're going to be miserable. So people will pay a premium to have a smaller lifestyle triangle and a more convenient lifestyle triangle. I used to think it was about distance, but now it's actually not distance so much as time. Because time, there are, on the west and the north, there are new housing estates only 30 k's from the city, but guess what? People can't get in and out because there's 100,000 people using the same 2 lanes every morning to get in and out of the city. Lower Plenty Road is a perfect example. It's a car park, you know. Same with Monash Freeway to a large extent. It's a nightmare. It's a car park. Completely dysfunctional. It should have been 5 lanes from day one. You know, what were they not thinking? So this is the thing about Melbourne. A lot of people just think people work in the city. Oh, everyone works in the city, so they're closer to the city. No. People do not work in the city in Melbourne. This is the thing. Many people were surprised to learn that nearly 3/4 of jobs in Melbourne are located more than 5 k's from the city in the suburbs. Another surprise is only 20% of those suburban jobs are located in medium or large activity centres. These red dots represent where majority of employment hubs are located in Melbourne. Now, this is just purely volume. Obviously, on the west and the north, Broadmeadows, Tullamarine, Sunshine, Footscray, they're predominantly blue-collar jobs. On the other side, in the eastern suburbs and the Bayside, they're predominantly white-collar jobs, hospitals, financial planning companies, mortgage broking companies. So a lot of people that live in Kew, which is the #1 growth suburb in Melbourne for the last 25 years. Kew has grown by 200,000 every year for the last 25 years. Most people that live in Kew do not work in Kew and send their kids in Kew to schools. They do not work in the city. So the commuting time is only 10 minutes, you know. The other 80% are sprinkled throughout residential areas, standalone developments, although some definitely are, rather than most are located relatively small centres, which is the major activity centres. So if we map these out by volume of job hubs in Melbourne, you can see that Clayton has one of the biggest ones in terms of representational volume. So let's say this whole bar graph represents 100% of all jobs in Melbourne. And then you get the mean size of all centres. Clayton's one of the biggest ones. Tullamarine Airport, thousands of people work there. Clayton is all industry and manufacturing. It's predominantly blue collar. Kew and Hawthorn is all white collar. So it's medical suites, accounting, marketing, all those kind of areas. Box Hill as well is a mixture. St Kilda, Moorabbin, Heidelberg, Malvern, Bayswater, Dandenong, Footscray, Glen Waverley, Frankston, Glen Iris, Malvern East, Cheltenham High, Ringwood, Wanton South, Mini Ponds, when you get to Latrobe University, Narre Warren, Burwood East, Oakley, Greensborough, Broadmeadows, Blackburn, Heathbourne, Sunshine, Preston, Northland. The shopping centre is massive, 10, 15, 20,000 people, so a lot of people will pay a premium for a lifestyle triangle if they can work in Blackburn, go to school, send the kids in Blackburn, and then also, live in Blackburn, obviously. The next flood that's coming in of migrants that's coming into the country right now, the Chinese, the Asian flood of migrants has kind of ceased, and now we've got predominantly Indian people coming in. So if you look at, I'm Polish, we came over in 85 to Australia with the Russian Polish flood from Eastern Europe. And one of the key things about becoming successful in property investing is understanding who's coming into the country or the state and what is the value system. Why are they coming here? What do they want to do? And if you look at the Indian population, they're highly educated, a majority of them being in IT or medical field, and they value school and education above everything else because ultimately they come here for the kids and the future generations. So they will value schools, especially public schools in catchment areas. And this is why places like Glen Waverley do really well with that community where you can be in the catchment area, have really good education, pay the price for a good house, but you don't have to pay thousands and 30,000 for a private school. You pretty much can get into the public system, but still have the prestige and the quality of education that they're after. So every kind of decade has a defining country of origin that kind of comes in. And look, sometimes it's broken up. You might have 10% from England, 5% from New Zealand, from different countries in Europe, Italy, Greece. But if you want to be successful, look where the dominant majority is coming from, and then look what they will do in terms of their function. Why are they coming here? What's the priority? And you're going to find a lot of people from Asia, from India, from Eastern Europe, where I'm from. The parents value education above anything else. They will sacrifice holidays, they'll sacrifice lifestyle as long as the kids get into the best possible schools. So school zones can never be underestimated. This is a heat map of the best schools in Melbourne, secondary schools, obviously. The red section is representing the best schools, and you can see that they're concentrated in the eastern suburbs and the Bayside, and the city itself, because you have McRobs, obviously, and different schools. And then this is a visual map showing you the highest ranking schools, the blue being 100 out of 100, followed by the green and then aqua and then red 97. So you can see that they're all pretty much disproportionately concentrated in the east, and the inner Bayside area as well. Obviously, there's exceptions. There's good schools. I mean, Toorak College in Frankston, Mount Liza is quite good. But you can see there you've got the ranking on Melbourne High. You've got McRobs Girls School, 100 out of 100. Then you've got Berwick, Werribee as well, public schools, or even Catholic schools. These are government schools, actually. The best schools to target are non-government schools because they tend to be prestigious in terms of exclusivity, and they're very good for networking as well. So you can see that you've got Burwood, Bowen, Keysborough, Mount Waverley, Glen Waverley, Glen Iris. Then if you go to the next, Canterbury, Brighton for St Leonard's, Melbourne Grammar, Kew, Canterbury, Toorak for St Kevin's, one of the top schools in Melbourne, Hawthorn. By the way, I've got friends that send the kids to St Kevin's College in Toorak. And they don't send the kids there and pay 35 grand a year because it's highly ranked. They pay it because they want the kids to hang out with other kids whose parents are also earning the same dollars. And for networking, this is where people form lifelong relationships and they marry into these people. So this is why a lot of people pay that big bucks to send the kids to these private schools, not because of the ranking, guys, because of networking, which is maybe more important than school. If you can't get rich yourself, hey, just marry into it, God, I wish I married rich, just could have just hanged around at home, played PlayStation and kicked back, go to the gym, and my wife would be on like $1 million a year. That'd be so cool. Different life. Anyway, Armadale, Killer East, Ormond, Kew, Berwick, Cranbourne, and then you have Kilmore, Canterbury, Glen Waverley, Wantirna, Ringwood. So there are exceptions. There's places like Werribee that have good ranking schools, 98, 100, but they are not prestigious in terms of money, obviously. So prestige is superior to everything else. But having said that, if you look at McKinnon, for example, High or Glen Waverley Secondary College, people pay up to 100,000 more to live in the catchment area than outside the catchment area. Walk score is another thing. It's the convenience of the walkability factor of a suburb and how quickly you can walk within 5 minutes of how many restaurants you can access, cafes, schools, transport, tram, train, bus. So walk score heat map, once again, shows you the most conveniently located and equipped suburbs, and the red sections showing you suburbs that have no walk score. I mean, it's virtually very low. You got to drive everywhere. Now, not every suburb, this is not one and all ranking system. I like the far eastern suburbs on large acreages, and the walk score is very low there. I mean, I grew up in St Kilda, which is one of the best walk scores in Melbourne, but now I'm just over it a little bit. I actually like the far east where there's quiet, beautiful trees and no one knows anyone. It's a very private area, very safe, and away from everyone, which is pretty cool. So South Yarra has the highest walk score when this was taken, nearly 100 out of 100. Within 5 minutes walking distance, you can access over 100 restaurants, cafes, 6 of the best schools in Melbourne, tram, train, bus, everything. Hallam's got the lowest. Hallam, within 5 minutes walking distance, you're just in front of someone else's house. No, you won't get a coffee, and you definitely can't get a meal, and can't send anyone to school. Also, the Melbourne growth corridors, by the way, you're going to see a lot of stuff now on the media saying rent money is dead money. Why make your landlord rich when you too can have a metric on home only 60 k's from the city? You're going to see a lot of stories about infrastructure spending in Melbourne, roads, trains, tunnels connecting us to the city, connecting us to the airport. It doesn't equate to capital growth. Okay, these are all stories, guys. I've heard these stories for 25 years. They're not the fundamentals that make areas grow. What makes areas grow is income per individual household and individual combined with scarcity of land. So in terms of the last property cycle in 2006, and there's been little minor ones in between, you can see the suburbs that kicked off the cycle. It was Brighton and Toorak, literally. You know, and then Toorak kicked off, and then all the surrounding suburbs spilled over. And then we had, 2010, 2011. 2012, 2013, suburbs that go backwards slightly. 2014, you can see Park Orchards and Donvale and those areas, Templestowe. This is the far eastern suburbs, my favourite suburbs in Melbourne. And then 2016 and 17 was the peak of the property cycle, and then the cycle stopped and the properties went back by 10%. Now the media had a field day in 2017 because all they focus on is negative news. They won't focus on the growth. So what they focus on is this, where the suburbs go backwards. The orange section represents suburbs going backwards. Now, the analogy that I use to explain this is like you're going in a 911 turbo Porsche, 300 k's an hour, and you've been going like that for an hour, and then you slow down by 10%, which means you're still doing 270 k's an hour. But what they tend to focus on is this area lost 10%, this area lost 10%, this area lost 15%. Yes, but they've made a lot of money over the last 10 years. These areas have doubled and tripled. So people are still very happy in those areas. That's what the media doesn't report. And the same thing in Sydney happened, it was the same cycle just a few months apart from Melbourne. And then Sydney, the market went backwards. It has to go backwards eventually. And now it's going to catch up again in the next March quarter. So where are the best areas to target and invest in Melbourne? If you look at the past 12 months in Australia, out of all the suburbs, St Kilda has performed the best by 19.6%. And I can tell you St Kilda is going to kill it. Brighton and all those areas are going to take off, and I'll show you where I believe is the best area to invest in one second. But before I do, why are these areas going up? It's to do with income household demographics. If you look at the household, the highest income per individual, the average for Melbourne, by the way, is $674 per week. That's the median personal weekly income for Greater Melbourne, $674 per week. In Cremorne, which is Richmond, people earn $2,537 per week, which is 5 times more, let's say 4 times to 5 times more than in Richmond. East Melbourne, $2,285. Port Melbourne, $2,190. Middle Park, $2,353. Toorak, $2,311. Elwood, Albert Park, St Kilda West, Clifton Hill, and then South Yarra. So these are the best areas to target for the fundamental reasons, because they have the richest people living there by choice. These people could buy anything anywhere, but they choose to buy in these areas. And these areas have scarcity of land. And they're all very different. I mean, Toorak's got large blocks compared to Richmond's got tiny blocks. The average Toorak block would be probably 800 to 1,000 square meters, where the average Richmond house would be 130 square meters. But having said that, these fundamentals apply to these areas. And these areas often have very good schools and very good transport and very good proximity to the city, and also very good cafes, restaurants, and lifestyle areas. If you look at the best performing houses, St Kilda East Victoria, 23.6%, 1.3 million. It just keeps coming up over and over. Canterbury is another one that came up. Windsor. So that's Windsor in Queensland, actually. So St Kilda East for Victoria and Canterbury. So what factors really determine drive property prices? It's not location. that determines capital growth. It's scarcity of land, so no more land left to sell, and extreme redevelopment restrictions combined with high demand by the right demographics to determine high capital growth. So what types of properties can you target in Melbourne? Townhouses are it, guys. They are the best vehicle to grow wealth because it's a house without a backyard. You're taking advantage of the privacy factor. You can park the car inside your property, go into the kitchen with your shopping. You can entertain. You've got balconies. You've got your own little backyard. You have a barbecue. So you get the privacy of a house without having maintaining the lawns that no one really wants anymore because everyone's indoors. And townhouses have outperformed houses at the peak of the last property cycle in 2017. You can see that, for example, East Q, the median townhouse is 910,000, went up by 38.93% for the year till March 2017, where houses only went up by 0.06, less than 1%, because the median price is 1.786 million. Same thing happened in, for example, Moorabbin. It's a nothing area, probably the cheapest part of the Bayside, or Glenira, I should say, but the beachside part of Melbourne. 606 was the median price for a townhouse. It went up by 36.818%. Houses, 13.33. Also very good, but not as high as obviously townhouses. Why? Because more people that want to live there, they might be priced out of a detached house, so they go for the second best thing, which is a townhouse, and some of these townhouses, by the way, guys, are getting bigger than the original houses in the suburb. There's plenty of townhouses being built in Bentley East, for example, that are much larger than the original 3-bedders that were built in Bentley East on 600 square meter blocks. So people want a larger dwelling, but they don't necessarily want the grounds anymore. They don't want to pay extra for the backyard. They still want a tiny little backyard, but not 3rd acre, like we did in the 70s. No one wants that anymore, and no one can afford it. No one's willing to pay the price for that. They'd rather have holidays and better quality of life than maintain the grounds. And Williamstown North is a perfect example. 546 for townhouses, 28% growth. Houses 1,090,000, negative 9.92. So townhouses, your number one vehicle. Apartments, complete disaster in Melbourne. Do not buy them. It's a trap. There's thousands being built, 73,000 apartments under construction right now in Melbourne. The blue section represents towers that are being built. Even with the 3-to-1 ratio that I teach, and that works, okay? So if you've been following my methodology, I tell people that you can only buy apartments in areas where houses are on average 3 times more expensive than a 2-bedder. So for example, Toorak houses are 3 million, 2-bedders are 672,000. That's a 3.46 ratio. And they do well. Like, for example, in 2019, December, Baldwin was the #1 area for apartments in Melbourne, 802,000, 27.9% growth. Yarraville, Caulfield, West Melbourne, Toorak, Blackburn, Doncaster East, Prahran. You'll find that these townhouses, these 2-bedders are at least 2 to 3 times more cheaper than a detached house. So if a detached house, for example, in Caulfield, the 2-bedder is 700, a house will be 2.1, 3 times the value of a apartment, which is why it's growing at 19%. So what that means is that you're so priced out of that area, it's either going to be a 2-bedroom apartment or nothing. So you're either going to live in Toorak, or let's say, for example, Caulfield, or you can't live there because your house is completely out of range. Here are the top suburbs for apartment growth in Australia, and Yarraville, this is for 2019, and Yarraville had the second place, 22.1%. And then you had Victoria Caulfield, once again, then you had West Melbourne, then Toorak, then Blackburn. And that's why, because they have the 3-to-1 ratio that we talk about. By the way, if you want more information about any of the properties I'm about to show you, just send me an email with the heading of the property. I'm about to show you some properties that I have sourced, that are shortlisted for my clients, that are not available on the market, especially some of them are, but 2 of the projects are not available. So if you want more information, you have to email me. Or if you have any questions, just send me an email to conrad@investorsprime.com.au. House and land is a complete disaster in Melbourne, and the reason for that is because it has the growth corridors are located in areas which are high risk of unemployment, which is the red sections, and the dark blue sections are areas that have a low risk of unemployment. And because of that, you have high crime, which I talk about as well. St. Albans being the Melbourne's homicide capital, Victoria, with all the problems of that area. So you can see the overlay is, without question, the dark grey sections represent the so-called growth corridors, and then you have the highest crime rates in those areas as well. 6 reasons why Melbourne house and land packages continue to underperform. Number 1, you have a dominant low socioeconomic demographic that reside in these areas, and they come with high level of domestic violence, burglaries, theft, road rage, gangs and violence. So people don't want to live there if they can avoid them. Social issues associated with isolation, lack of community. No one talks to anyone. No one trusts anyone. Lack of government planning and spending around transport, accessibility to city. People get trapped and they spend an hour in a car going to the city and working. Some people are getting stuck for up to 2 hours per day. Can you imagine? I mean, if you like in Pakenham or Berwick and you want to drive to the city, it's 2 hours. You catch a V line, but if you want to drive, it's terrible. Lack of lifestyle shopping strips, parks and amenities as well. Average to bad local primary schools and secondary schools. You haven't got 2x, St. Kevin's College in one of these areas. You can't manufacture 100 years of history in a new estate, no matter what you do. And inadequate, access to medical clinics and hospitals as well. So because of that, you have the highest mortgage default rates as well. Number 1 is Wollert, 20.3%. And by the way, mortgage stress and mortgage defaults are very important, because if you're an investor and you buy into a new estate in Lyndhurst or Lynbrook or Craigieburn, and in Craigieburn you have 17.9% of houses with mortgage stress, meaning they're three payments behind with their mortgage, which means the banks can illegally repossess the house and sell it. You're going to see a lot of properties being fire sold constantly, which means your capital growth references will be very low. Therefore, you won't be able to get capital growth because there's always people fire selling properties in your suburb. So the number 1 reason to avoid these postcodes, Clyde, Clyde North, Cardinia, Donnybrook, Wollert, Lyndhurst, Lynbrook, is because they have extremely high mortgage stress. People have borrowed 95, 97% to get in there. First home buyers, they've leveraged themselves. They went to Harvey Norman, they bought all the furniture interest-free or interest deferred for 5 years, and now something's happening with their job and they just fall behind and they can't get back and they lose everything. It's very sad this is happening because these are traps that are being set for them. But people are people, and this is the reality, and you're investors. So you've got to be aware of these things. By the way, I'm not judging people living in these areas. I'm just saying, you, as an investor, you've got to be aware of the problems associated with some of the suburbs, especially if those issues, these social challenges, are going to affect your capital growth of your property. So that's going to be something you've got to be aware of. You can't just pretend it's not happening. Otherwise, you're gonna lose money. Okay, so you just got to be aware of it. Fantastic. So the biggest problem with house and land estates is that the developers that build in these estates, like FKP, Sunlands, Villawood, Mirvac, Peat, Landlease, Stockland, are holding thousands of blocks of land that they can release any day in those estates. So, for example, Peat Limited, Peat's one of the biggest. They're a really good developer, by the way, and I've sold Peat houses. They're excellent. The average number of sales per year is 2,623, and they're holding currently 44,577 blocks of land in those so-called growth corridors predominantly. So they've got 17 years of stock that they can release at any time. Now, this is publicly listed knowledge because they're publicly listed companies. So you can see there, like you've got FKP, 14 years of stock. They're holding on to 6,529 blocks. Sunland has 4,857 blocks. Villawood, 5,334 blocks. Mirvac's got 26,379 blocks, 11 years of supply. Fraser's Australand, 17,658 blocks. Peat, 44,000. Landlease, 46,000 blocks. Jesus. Stockland, 67,000 blocks. So the average is quite high, but the combined volume is 212,000 blocks, 13 years of supply, which is crazy. So there's no scarcity in those areas. They can release these blocks anytime when the market shows demand, and that's the issue that I have with these areas for investing. Melbourne's richest and poorest suburbs. There's a big distinction that is occurring between the have and the have-nots. And the most advantaged suburbs are East Melbourne, Glen Iris, Surrey Hills, Toorak, Brighton, Ivanhoe East, South Yarra, Camberwell, Belmorris, Albert Park. And the most disadvantaged suburbs from the Australian Bureau of Statistics are Broadmeadows, Corio, which is North Lane, Campbellfield, Morwell, Breeside, Doveton, Meadow Heights, Maryborough, and St Albans, south and north. Townhouses are it, guys. They outperform. That's what we want to stick to. Now, what's the best undervalued long-term high-growth suburb to target in Melbourne right now? So these is my predictions for 2020, 21, and even long-term. I would say in the Bayside area, Albert Park, Port Melbourne, St Kilda East, West, and Balaclava. Brighton, Bentley, Bentley East, Elwood, Hampton, Sandringham, Blackrock, Belmorris. And then for entry level in the Bayside and Southeast, you've got Cheltenham, Hyatt, Mentone, Mordialloc, Aspendale, Eathvale, Chelsea, Bond Beach, Chelsea Heights, and Carrum. And then if you go to eastern suburbs, Mont Albert North, Kew, Canterbury, Camberwell, Surrey Hills, Hawthorn, Balwyn, North, and Waverley. For entry level, cheaper, Box Hill North, Heidelberg Heights, Blackburn, Burwood East, Mitcham, Bayswater, Doncaster East. My number one top capital growth suburb to invest in for 2020 and 2021 in Melbourne is, without question, without doubt, are you ready? I don't know if you want to, do you guys want to hear this? Who wants to know what it is? No one? I won't mention it then. Say yes if you want to hear what the suburb is. All the yeses. People have fallen asleep. Anyone else? Just two people? I'll just send you guys an email. I put yes, please. You want to hear it? No one. Everyone's going to sleep. All right, so the number one suburb with that question, and if I get this wrong, guys, you can sue me, is Balaclava by far. And Balaclava from Select Residential Property, SRP, is deemed to forecasted to grow at 20% between now and 2022, followed by South Melbourne. I think it's going to do better. I think, and look, just looking at Balaclava now, I tweeted this the other day. By the way, you can follow me on Twitter. It's just Conrad Bobbylake. I'm the only Conrad Bobbylake there as well. Balaclava had a 100% auction clearance rate based on 22 auctions one weekend. Everything is selling in Balaclava. It's one of the best suburbs. But what people don't tell you, what's so good about it, is it's an Orthodox Jewish suburb predominantly. And it's got Yeshiva College, which is the best Jewish school in Australia, and it also has a Jewish museum, and it also has large Jewish community centers, and it's got the synagogue. So Orthodox Jews need to walk there on the Sabbath, and therefore they need to buy in the area that they live in, and they love property. Jewish people are very good business people. They make a lot of money. They don't show off. As a culture, it's a culture that teaches you to be very conservative with what you wear, what you drive, not to show off that you have money. So, and they do make a lot of money because they are very good business people by nature. Look at Hollywood and Wall Street. It's all Jewish people basically. And when they do have money, what do they do with the money? They don't like the stock market because it's all corrupt. So what do? They buy land and property. And that's why the predominantly Balaclava, St Kilda East, is controlled by the Jewish community. So anything else on the market, they snap it up immediately. So this is a development this is why I source in these areas. I can source anywhere for my clients. I choose to do the research first, and then I basically source the properties from the best developers after. This is a development that's sold out to the public. I've reserved a few for my clients. There's still 7 available, and then that's it. But if you go to the actual site itself, it says sold out. It's number 99 Hawthorn Street, Balaclava. It's opposite Yeshiva College. And these are 2-bedroom townhouses from $855 to $1,095,000. And this is one of the best projects that I've ever sourced. I think this is probably $100,000 undervalued. By the time this is an off-the-plan purchase, construction has started just now, last month in January, and completion is mid next year. They're triple story townhouses with a bedroom downstairs, ensuite, car park underground, and then you have your open plan living, and then you've got upstairs another bedroom, and then you have a rooftop terrace overlooking a beautiful balaclava. So these are architecturally designed. Great team, great builder, and great architect. Every panel here you can see is very unique. It's not a typical property, I would say. Even the external cladding and the paneling is very unique. This is a timeless work of art. I mean, these properties will be amazing when they're completed. It's something that you can buy and hold, never sell, for keep it for generations to come. So for anyone that buys these properties, I can guarantee it's going to be the jewel of the crown of your property portfolio. I wouldn't be surprised some years if these properties do 20% growth. You know, everything in the property is just amazing, amazing location. And the rooftop terrace is a very nice touch because the area is very much a heritage protected area with height restriction and density restriction. So you'll be overlooking a lot of the rooftops. And because you haven't got any courtyards, you've got little dysfunctional courtyards, this gives you that privacy where you can have a barbecue, and you've got a barbecue built in there with taps and running water. So you can have a little, you know, read a book on top or have a party, have your friends over. And you're 2 minutes from the beach, 2 minutes from Auckland Street, 2 minutes from Fitzroy Street. I mean, it's in the heart of Melbourne. You know, I mean, Hawthorne, Balaclava is St Kilda East, by the way. For those who don't know, it's virtually the same area. It's just a separate name for a suburb, but it's St Kilda East, effectively. So you can see that everything is just amazing inside, marble all the way to the ceiling. Even if you look at the taps, the toilet, everything is fantastic. It's not builder's range. This is the high level property. And location wise, I mean, you know, if you know Melbourne, Hawthorne Street, very iconic, goes right down to the beach. So this is between Balaclava and Inkerman Street. So you got the train station around the corner. You can walk down to the tram, cafes, restaurants, schools. It's all there. Ticks all the boxes. If you're interested in one of these properties or the brochure, due diligence kit, or price list, just email me and I'll send you the whole thing with the availability. This property boom will start in Melbourne, Brighton and Toorak. This is Brighton East. This is a completed townhouse that's ready to be lived in. Just completed now, brand new, overlooking probably the best park in Brighton and Brighton East, which is Lancox Park, which is amazing. And these are 3-bedroom townhouses. So you have 2 bedrooms on the ground floor. So you have 1 bedroom on the ground floor, open plan living, and you have the back you can open up, and then you've got a courtyard, and you've got access to Lancox Park from your backyard. And then upstairs you have 2 bedrooms with 2 en-suites, and you've got a study nook and a balcony. And then you have underground double car garage with storage. This is the living area. You can see that you open up the back, you've got sliding doors, double glazed, and then you've got a small courtyard with a fence, and accessible by key. And then you've got one of the best parks in Melbourne, with a lake with ducks. Amazing, just purely for the locals. So this is a property that's geared towards the wealthy part of the market. This property is on the market for 1.895, and I can get it for 1.845. I can get $50,000 off this property as a discount. Very good level of fixtures and fittings. And in terms of livability and functionality, it's a very good townhouse. The other one next door, I've just had one of my clients buy that property in January. Sorry, they bought last year, they settled in January. It was leased in 1 day for $950 per week. And the literally was opened up on the Wednesday morning by Vanessa Fisher from Changing Places Real Estate. She had 3 couples apply instantly at 9:30 in the morning, one of them being successful, and the professional white collar couple $950 a week. So these get snapped up. To lease these properties, it's 1 day, guys. It's not even a week. It's literally 1 day, 1 opening, and they're gone. In one of the best top end aspirational suburbs in Melbourne on the beach, which is Brighton East. Second only to Brighton, which is probably, there's only Toorak and Brighton in Melbourne in terms of prestige, really. Some say Hawthorne, Canterbury, and others, but really it's Toorak and Brighton. Very large storage, large master bedroom. So architecturally designed, very different feel from Balaclava, not as upmarket. This is kind of a almost like a Hamptons feel, pared down a little bit. And then you got the park, which is just amazing. I used to live in the area, so I used to take my daughter there all the time. It's one of the best parks in Melbourne. It's always quiet. The playground equipment's amazing. You've got a lake in the middle of the park. It's just serene. And that's the back of the townhouses facing the park. So one of the best projects that I've ever sourced in 7 years of doing this, I would say probably my best favorite top 3 projects that I've sourced for my clients. So it's one of those things where you just buy and hold and never sell. And the third project is also in Brighton East. It's off the plan. It's a 12-month build, and these are 3-bedroom townhouses with double lock-up garages, 2.5 bathrooms, 1,020,000, 1,050,000. There's 10 of them only. There's 2 rows of them. There's 5 on the street frontage and 5 at the rear. The rear ones are cheaper. The front ones are more expensive because they have street frontage appeal. Architecturally designed, very cool, very trendy, gearing up for the professional young couple that grew up in Brighton. Maybe they're saving for a house. They're very expensive house in Brighton East. Maybe not ready to commit yet to anything, but they're making money. This is perfect for them. Low maintenance. That's a streetscape there. This is like either off South Road, which is Hemming Street is off South Road. South Road goes into the beach. So you're literally, I would say, if you drive your car 2, 3, 4 minutes down to the beach, you're probably 3 sets of lights away from Southland Shopping Centre and probably about 10-minute drive or 5-minute drive to Centre Road, which is one of the best shopping strips in Bentley, which is a suburb next door. You got 6 of the best, most prestigious schools within that suburb in Brighton, places like Furbank, Halbury, top schools in Melbourne. Really cool property, great depreciation, aesthetically stunning. And these are 3-bedroom. They've got a bedroom downstairs with a small courtyard at the front with an ensuite, and they could be used as a home office as well. Double lock-up garage with rear access, and on the first floor, you've got 2 bedrooms with 2 ensuites, open plan living with a balcony. Perfect little property, 179 square meters. So it's really good. It's like a small house in Brighton East, basically. Out of the 10, 3 have sold. I haven't released this project yet. I'm still waiting for the brochures from the developer, and I should have them next week. But I've just notified some of my top mentoring clients, and they have snapped them up because they were pretty much perfect for them. Now, you obviously have to qualify. You've got to have the right income and tax to take advantage of these. But this is one of the best projects also that I've sourced for a long time. So the best 3 suburbs, really, Balaclava by far is going to be the best for growth. It will outperform Brighton East, no question in my mind. And then the second best area is going to be Brighton East. And you've got the high-end property in Brighton East overlooking Lancox Park. And then you've got Hemming Street, which is just a normal street in Brighton East, next to the highway, next to closer to the shopping centre. So these are the 3 best developments that I've got currently. If you're looking for value for money, if your budget is a bit lower than these, then the best value for money in 2020 for capital growth, and it is being, look, it's really hard in Melbourne to get something that's cheap, but I would say it's Heidelberg Heights and Heidelberg West. These are ex-housing commission areas that are very close to the city, 9, 10 Ks. Beyond them, Heidelberg, Eagleman, Ivanhoe are very up higher-end white-collar suburbs where houses are $3, $4 million. But you've got these 2 little suburbs just beyond Belfield, where you have all these housing commission units that look like this, and they used to be government-owned. The government has sold them up, and the private sector has purchased them, and then they're redeveloping them en masse. The whole area is going through gentrification. So they're ripping them down. You can't do anything with these properties. They have asbestos in them. You can't renovate them. They're too small. They're completely dysfunctional. And there's nothing redeeming about them. Low ceilings, terrible layout, just the whole thing is a write-off. But some of them come with 900 square meter blocks. So developers are buying them up and redeveloping them into entry-level townhouses, big and cheap, which is what you need. This one here sold just recently last year in Heidelberg West for $769,000 to one of my clients. And it's a very nice 4-bedroom townhouse, only 3 on the block. Very nice kitchen. It's all builder's range, guys. You don't need to go up spec. This is Heidelberg Heights. This is not Brighton. This is an area where you're going to get $525, $550 rental a week for this property. So you can't afford to go high spec. But it's high ceilings, marble splashback, very good Caesar stone and granite bench top, stainless steel appliances, entry-level German or Italian appliances, 4 bedrooms, 3 bedrooms upstairs with 2 en-suites or 3 en-suites, and then downstairs you've got a bedroom that can be a guest bedroom or a study or a home office with a small courtyard as well. This one had a single garage with a tandem garage car space. Some of them have double garages, some of them have single car garages. So I'm getting them all the time now, and it's a really good opportunity to buy them in an area that's very close to the city, 9, 10, 11 k's from the city, depending on which part of the suburb you measure, to the centre of the central business district. This one is 785 in Shelley Street. There's one left in this project, these are 3-bedroom townhouses overlooking Shelley Park, which is a really nice park in the area. So for 785, this is like the cheapest entry-level property that I would look for in Melbourne to get good capital growth. And if you look at what's around there, I mean, Heidelberg Heights and West are surrounded by some of the top-end eastern suburbs in Melbourne. You're 5 minutes distance from you know, Northland Shopping Centre, but beyond that, you've got the whole hospital precinct. You know, I mean, you've got Heidelberg Hospital, you've got the Austin Hospital, which employs thousands of doctors and dentists and specialists in the surrounding areas as well. You've got a whole medical precinct, really good schools, great transport, very close accessibility to the city by train, tram, also highway connections, links to the East Link. I mean, it's all here. So in this example for 785, you have single car garage with a courtyard, open plan living, and upstairs you've got 3 bedrooms, one being the master bedroom with a built-in robe and an ensuite, and then the others share an ensuite. So, you know, and I get these all the time. They come and go. These developers do one back to back. So if you're interested in one of these as well, send me an email and I'll send you all the information. So if you're interested in any of these properties and you want to know what's available, or if you have another budget and you want something else specifically, don't hesitate to email me at conrad@investorsprimerealestate.com.au, and I can shortlist some projects for you and send you some brochures with some price lists. My office is in St Kilda as well. So if you are from interstate, if you ever want to look at St Kilda, Brighton, or some of those best suburbs in Melbourne, I'm an expert on those suburbs. Definitely give me a call or drop me an email. We can organise a time to catch up in my office, and I can take you, show you around some of these areas and show you some of the stock that I source directly from developers. By the way, for those who are interested in learning more, and I hope you are, because there's no such thing as a learned person. You're either learning or you're regressing in life, as I say. And I'm learning after 25 years of doing this. I'm still learning myself every day about property investing from valuers, other successful investors, and definitely developers. I would like to invite you guys to my up-and-coming Real Estate Fast Track Weekend, which is a live 2-day event that I run in Melbourne. I run 10 of these a year in my office in St Kilda, and they run for Saturday, Sunday for 8 hours per day, pure contents and education. There is nothing to buy at these weekends. It's purely just to educate you. Day one is purely on finance and portfolio structuring, and you'll learn a proven method of how to pay off your current 30-year home loan in 15 years or less, saving yourself tens of thousands of dollars. If anything, if you just come for that section, I can guarantee it's going to be worth your time, because people spend 15 years more paying their home loan. And I'll show you how to buy and structure a large property portfolio from scratch that can replace your income. Day 2 is all about property due diligence and research, where we go through all the suburbs in Melbourne, property cycles, the history back to 1890 of some of these suburbs, school zones, which areas work, which don't. And we also have a field trip where we put you on the bus and we take you around and show you 4 or 5 suburbs, and we do research on those suburbs and projects live. These are priceless events. They are free completely. I used to charge for these, but now I've made them available to everyone for free, but seats are limited. We can only do 50 people or 45 per month, and I run only 10 of these per year. I've just had the first one in January, and it was about 25 people overbooked, so we had to turn people away at the door, which wasn't very nice because they didn't register, and the room was full, and the bus only has 48 seats. So I encourage you to register yourself for that. Also get a copy of my book on Amazon or bookonfinance.com.au. All the secrets of structuring your portfolio and retiring are in that book. It took me 3.5 years to write that book, so definitely worth the 20 or 30 bucks you can get it for on Amazon, whether it's digital or hard copy. Also, there's a special bonus, just because you stay to the very end of this webinar, I want to give you access to my free home study online, no strings attached, nothing to buy, worth $497. and I'm going to send you a link after this webinar. We can access that, and it teaches you a lot of stuff around the property market. Definitely how to get your team together, how to source property, how to pre-qualify your team of experts around you, how to supercharge your borrowing capacity, all the little nuggets that I've picked up over the years. It's completely free. There's nothing to buy. You literally just go in, register, upload your manual, which is 365 pages, and you can start watching and getting educated instantly. That's the URL, a link. If you type that into your browser, it will come up. And there's also, it's 10 hours plus another 3 hours that I just added last year on finance, because I upgraded the finance section, plus a 265-page manual. So you can start watching that instantly and getting educated on the property market. Now, I'll be recording a new one of these this year because that is a little bit old now. The market has moved, but 90% of all the information is pretty much current. Also, I'm going to give you a replay of this webinar as well. There'll be a link that will be sent to you just in case you missed something or you want to replay something or forward it to a friend or family member. There'll be a replay link that I'll send to you probably the next few days. And for those of you who have any questions or anything about anything you've seen tonight, feel free to give me an email, conrad@investorsprime.com.au, especially with regards to properties and property sourcing. That's all I do all day. I love property sourcing, and I'm very passionate about the Melbourne property market. That's it from me, guys. Thank you very much. You've been an amazing audience, and I hope to see you on the inside at one of my future events.